All right, so let's go ahead and add some context to what I'm talking about. So I'm talking about two indicators here. You got your Chandler exits and your parabolic SARs, right? So let's just break down Chandler exits and what we got going on here. This is a great setup, an example of Chandler exits and how good they work. Looking at CAVA here and probably mid-November, you get a breakdown below the Chandler exits, which are these dotted lines, right? And it doesn't come back above it until mid-January, right? So you have this prolonged period of over roughly about 2 months where there really isn't a buying opportunity, even though it kind of looks like there might be right here, right? I mean, that's a sucker's bet. You're still below, so why would you buy? You don't, right? So the only time to buy for me on my strat is when the stock is above Chandler exits. And the reasoning behind that is the supply and demand dynamics that we are trying to get, right? So I only buy when So I only buy stock when it's above Chandler exits. I won't touch it if it's below, unless you get a really great setup that I'm seeing on some other indicators. But very rarely do I seek out buying the stock below its Chandler exits. I just don't see it being that interesting of an opportunity when there's so many stocks out there that I could find better setups on, where the behavior of the stock is going to be more favorable to me. That's another problem with people you see a lot. They buy a stock and then it goes against them. And then they have this mental psychology that, once it gets down below 5%, on their investment or their trade, they're down 5%, they'll get out. Maybe it's 8%, that's their stop, right? Such a weird thing to do. Because you're buying, you're again trading yourself, right? You're not trading the stock. So it might feel well to say I don't let stocks go below 5%, but that's not the right way to play it. And you just let the chart give you your stop itself, right? Like when I bought this stock, the day it popped above Chandler and it closed, I just bought here and I said, if it gets below Chandler exits, I'll just sell. And it never did, right? And it was an amazing rally. And that's a very easy way to approach it. Sometimes, the Chandler exit might be down here, and then I'm going to be buying up here. Well, I'm not going to use the Chandler exit as my stop there. I'm going to be a little bit more picky. Maybe I would use a close. If the stock was to close within this range, maybe then I would get out, right? So I'm going to be a little bit more picky. So I'm not going to use the Chandler exit on this type of setup, right? It's not as good. It's good when the price is really close and you can manage risk. That's when you want to do it, right? That guy that might have, hey, I only sell a stock if it goes 5% against me. Well, this is almost like a 5% drawdown, right? So let's say he waits, he's down 5% right here. He's going to get out. It's not the right call because you're above Chandler exits and the behavior of the stock is probably going to be favorable to the upside. So he's sold on a possible bounce, right? And you see that happen a lot to people. It's because they have silly rules. I don't want to say silly. Maybe they do a great job. I don't see how it's possible. So with this is one great way to understand that the behavior of the stock is going to be more favorable to you when it's above Chandler exits. Now, I'm not sure if I mentioned this, but I'll go ahead and say it. And that's because buyers, when you're above Chandler exits, have less sellers, less resistance. The trend is going to be more favorable, right? And you have shorts covering their position. Now, that's not always notable. I mean, how many people, what's the percentage short on a stock? Like on good companies, it's like less than 1%, less than 2%. So you're not going to get a lot out of it. You shouldn't expect that. You should just know on good companies like Nvidia, Apple, CAVA, when you get above Chandler exits, there's just going to be less resistance and fewer sellers, right? And it's going to be more favorable to you. Now, when you're below, it's going to be the opposite, right? You have people shorting the stock. You have people selling the stock. So you're going to be working against that. And I think that's pretty clear in this example. And it's clear just about anywhere you look. So that's how you use one of those behavior inputs to understand what the stock's going to possibly do in the near term. So now let's check out the parabolic SARs. Here we're looking at the same time frame, right? Same chart. And what's notable is you see the day we went below the Chandler exits. We've already touched on that. And then you look off to the chart, off to the left here, you see your parabolic SARs, which are these white dots, which is supportive of upward price. And now you see the dots above the closing price. And this is the day that the stock, a day after the stock was below Chandler exits, right? So it hit the Chandler exit beneath it this day, and then the next day you get a parabolic SAR switch. That's a reversal. There's no buying opportunity. Even though you get a nice recovery in here, it's not sustainable. And look at the selling pressure. I mean, these wicks. So these lines right here, these are called wicks. That's selling pressure all the way down, selling pressure, selling pressure, selling pressure. You won't see that when you're above Chandler exits, right? See here we're above. Selling pressure really isn't there, but you got more buying pressure, right? But back to this, you get that reversal. The parabolic SARs are now above price and pushing the stock down, and sellers just remain dominant, right? Until you get into this little range. We all know what this is. This is a double bottom, right? Here's the low, and then we get a close. We can analyze this. That close is within that range of this low. That's the double bottom. Even though we traded below it, it matters where we close, and we closed in that range. That's a double bottom after being about 2.5 months in downtrend. It's very notable, right? Then you get your gap up. You're above Chandler exits. A few days later, you get your parabolic SAR switch. And that's just an easy buy. So, you buy once here in anticipation of hitting the parabolic SARs, right? Because you have a double bottom and you're out of Chandler exit. So that's your first buy. And then once you get your reversal, because this is what you're forecasting, right? Because we've done our thesis, we think the stock will turn around because we know the behavior input, the Chandler exit, is now favorable for us for the first time in 2.5 months. So let's see what it does to the parabolic SAR, because we know back over here, when we were below Chandler exits, it immediately took out that bottom parabolic SAR right here and reversed it, right? And then we get our reversal right there, and then I bought again. And people might say that's crazy, luck. No, because you're at resistance, and you broke resistance that day too. Resistance is right here.